What's good, YouTube gang? It's your boy OTG Teflon Dom back again, coming to provide you with another banger. And we're just gonna continue off where we left off, and that's with the candlestick patterns. I know that this is a very important concept, so just keep going through the videos and we gonna get through this. So we get straight into it with the hammer candle. And this is created when the open eye and close are roughly about the same price. So it's also characterized by a longish shadow that indicates a bullish rejection from buyers and their intention to push the market higher. So from the example below, you can just start breaking it down. And as you can see, price opened here. It's a bullish candle. Price opened here. It went up. It opened here and it closed here. But before it made that close, there were a lot of sellers in the market and they managed to drive price down all the way here to the bottom of the candle, to the bottom of the wick, and from there buyers came back in, reinforced their position and brought it back up for the price to close here. So basically that's going to indicate that there are actually quite a lot of sellers in the market, but the buyers are winning. The buyers managed to overwhelm them. So of course this is the type of pattern that's going to occur at a downtrend, and then buyers manage to come in and push it back up and close it in a bullish position. So as you can see from the chart here, the market is in a downtrend, slowly going down, down, down. Different candles forming up but still going bearish. And then from here this candle occurs and it caused a reversal that led to a bullish market and buying opportunities. So the long shadow represents the buying pressure, and that basically clearly illustrates to us that a lot of buyers came in, because as you can see from the previous candle, the market was going down and there wasn't a lot of pressure from buyers to force that reversal up until this next candle opened and closed, and it closed in a bullish pattern. So that clearly shows that buyers really came in here and they just completely wiped out the market and managed to cause it to go back in the opposite direction. So with that pattern, will help you just understand how to calculate the direction the market is going to go into. And as you continue to identify these patterns, it'll become easier for you. You don't even have to go to your chart. But I would advise that you keep a candlestick chart close to you for reference, so that when you're looking at the market, you can always look at your chart and identify exactly which candlestick pattern is on the chart. So next off is the shooting star, which is a bearish pin bar, and it's basically the opposite of the hammer. Where the hammer occurs in a downtrend, this will occur in an uptrend, and basically the opposite concept of the hammer is what's going to occur here, is that sellers came in and they caused a lot of pressure and they forced the market into reversal. So with these candles, it's just about understanding the psychology. And once you understand the psychology, just by looking at your charts, you'll be able to read what's kind of happening in the market. You can never be too sure because nobody knows what's going to happen next. So very important, when this candle forms at a resistance zone, it's going to give you a high probability setup that the trend is about to reverse and it's time to start looking for sales. So the chart above shows a nice shooting star at the end of an uptrend. So let's just go deeper into that. As we can see, the market was going up, it was bullish on this candle, bullish, it didn't go lower, there were no sellers, and it got up to this point and then sellers came in and they managed to close the price down there. So that basically started indicating that a few sellers had come into the market, and from this point sellers managed to overwhelm them and bring the price down to here, but buyers were still part of the situation because price went up this high, but then ultimately the sellers overwhelmed them, brought price down, back down to here. Then maybe a few buyers came in, but it wasn't enough to force the candle to close bullish, and that basically triggered a reversal because it's basically shown us that there are more sellers than there are buyers, and from there on it continues to the next candle for it to go for it to be bearish and trigger a downtrend. So now in this moment in time, you're now going to be looking for sales and no more buyers. So it indicates an uptrend move and it indicates the end of an uptrend move and the beginning of a new downtrend move. And of course you're gonna use your support and resistance, etc., to confirm it. Don't just go based off that one confirmation. So next off we have the Rami pattern, and this basically means pregnant in Japanese, so blessings definitely. And it's a reversal or continuation pattern, and it consists of two candlesticks. So the first candle is the large candle, and that's the mother candle. And clearly from the name, the mother candle will be consuming the baby candle, which is the candle next to it. So this candle is considered a bearish reversal signal when it occurs at the top of an uptrend, and bullish when it occurs at the bottom of a downtrend. So this is the Rami bearish pattern, and clearly you can see the mother bar is consuming the smaller body, the baby bar. As you see, the smaller body is totally covered by the previous mother candle. So the colors don't even matter. That's what the book says. So the colors don't even matter. It's just about the concept of one candle completely consuming another. So this market tells us that there's an indecision period, and the market is about to consolidate or range. And in this type of a market, we're not looking for anything. We're just gonna chill, watch the markets, and wait for a breakout. So basically it states that sellers and buyers don't know what to do. Well, they know what they're doing, but they're just, canceling each other out consistently. So there are a lot of people buying, there are a lot of people selling at the same time. So you're just going to see the market going up and down, up and down, up and down, most likely touching your support and resistance zones that you would have laid out. And in anticipation of that, you will try catch the move of the breakout. So it basically gives us an opportunity to join in and to watch and wait for that moment for the breakout. And it's considered a reversal signal. So here we have another example. So as it says in the chart above, you can see how the trend direction changes after the Rami pattern foundation. After the Harami pattern formation, and the first bullish Harami pattern occurred at the bottom of a downtrend. Sellers were pushing the market lower. Suddenly price starts consolidating, and this indicates that the selling power is no longer in control of the market. Now on the other side, at the top, we have the bearish Harami pattern, and this one occurred at the top of an uptrend, and it basically indicates that buyers are dominating and that sellers are dominating, and they're about to cause a reversal and the beginning of a downtrend. So when this occurs during an uptrend or a downtrend, it's either going to be a continuation, which basically means consolidation, ranging. We're not going to be looking for trades there, and we'll just anticipate the breakout, and it's going to show us most likely a reversal from whichever way the markets were going. And as it says clearly, we'll study this in detail and how to trade this pattern as a reversal pattern or as a continuation. So you can use it in two situations. It's got two different scenarios to it. So next we have the tweezer top formation, and this is a bearish reversal pattern seen at the top of an uptrend, and the bottom formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. So that's the tweezer bottom bearish candle. And now, fuck me, man. Someone is calling me. Let me just get this. Might even just start the video again.